Hi, everyone. Welcome to Your Money Matters. Thank you so much for joining us. I am Angela Jarrell, your host and publisher of the Bauman Letter. And joining me are Ted Bauman and Clint Lee. Now, today we are talking all about volatility. Really, what else is there to even talk about these days? As a reminder, we do have an antidote for that volatility. It's called the Bauman Letter. For more information, click the link above or below. And again, you can check it out risk-free. You don't have to take my word for it. But this volatility that we're seeing, it's something of a virus, I would say. It is spreading all throughout the markets. We're not seeing it in one sector, one industry. It's really just completely prevalent right now. So Ted and Clint, I have some questions for you, of course. For one thing, we've got the billion-dollar question. Where is the market headed from here? Where do you see it going? And then the other questions are very related to that. What do you see? How risky is another correction or crash in our future? And what would it take for stocks to rally from here? Clint, if you could speak to that.
Yeah, sure. So let's first redefine, or at least define kind of what constitutes the market. I know everyone tends to get fixated on the S&P 500. We've talked about that before. S&P is absolutely dominated by five stocks. The top five holdings, because it's market cap weighted, make up close to 25% of the index. So that can really mask what's going on underneath the hood. So when I look at the broader market, you can look at small caps, you can look at mid caps, but you can use something I prefer. It's called the Value Line Geometric Index. And it's just a very broad measure of the average stock. So in my opinion, that gives you a very wide look at what's going on. And so I want to start there. I want to start with this Value Line Geometric Index. And the geometric is just how they average the holdings in there. And so here's a chart of that index going back a year. And we had this incredible rally kind of coming out of November 2020. We had it was over 30% gains. And then really for the last 4 or 5 months here or so, we've kind of been trading sideways. One of the concerning features of this is it does look to an extent like a topping pattern. But for that topping pattern to be confirmed, the key level that I'd watch on here is the 655 level on this index. I'm showing that with the dash line. That's been support going back to about April. We're sitting right on it. We're below the black line on here, which is the solid black line is the 50-day moving average. And if you break below this dash line, you look back, there's really not a lot of support that comes into play until you start to see the 200-day moving average. So that's one thing that I'm watching very closely with this chart. And then the other thing is just trying to figure out kind of where the sentiment lies right now. Are investors feeling more bullish and they want to get into riskier names, or are they more bearish and they're starting to entrench a little bit? And there's a couple different charts, just things in the market that you can monitor for that. So one of them is by comparing a low volatility ETF compared to a high beta ETF. And so that's the next chart I want to show. This shows the SPLV. It's a low vol ETF. The ratio compared to SPHB, which is a high beta ETF. So when this line on this chart, this goes back a year, when this line is rising, that means the low volatility ETF is outperforming the high beta ETF, and then vice versa. When the line's declining, there's two periods I want to highlight on here because they have some similar features. If you kind of look in the middle of the chart, the first green boxed in area I had, since this was trading sideways, that means low vol and high beta stocks were performing similarly to each other. And then eventually, when we had that big run starting in November of last year, that coincided with a breakdown out of that box on here. So that signaled that high beta stocks, the riskier areas of the market, were outperforming the safer stocks. And we reached a point to where, once again, just kind of over the last 4 months or so, we just been in this sideways trading range once again with this comparison. So just telling you that low vol is performing similarly to the high beta sectors of the market. And so this will really, where this goes relative to this box is going to tip its hand as the next move to the market. If we see a breakout above this box, that means you're seeing the low vol stuff outperforming. that's probably going to translate to a risk-off type sentiment in the stock market, and then vice versa if we can go back below. So that's a key level, key area I'm watching on this chart. And then the other one is an ETF that I think can really capture sort of the animal spirits, especially the risk-on sentiment in the stock market. And that's with the Renaissance IPO ETF. So ticker is IPO, holding exactly what you would imagine, recent IPOs in the market. And here's what I'm looking at on this chart right here. So this chart goes back also about a year or so. And one of the features is that it's carving out this inverse head and shoulders pattern. Now, a lot of people have heard of or are familiar with a head and shoulders pattern in the stock market. It's a topping pattern. An inverse is just the opposite. It's more of a continuation pattern. That means if you were in an uptrend before, an inverse head and shoulders tends to resolve the move back higher again. And so that's one thing I'm watching on here. You see I've got the areas kind of highlighted on this pattern. And so this gives us a couple key levels to really hone in on and watch. If we do see this pattern complete, you want to see the price of this ETF move back above 67. So that is the key level that I'm watching on this ETF. If you go back above 67, that is a very bullish move for this ETF and for, in my opinion, the stock market in general, for the risk on type sentiment to come back in. You can see right now that we're right around the 50-day and 200-day moving average on here, the green and black line. If that 60 level, it's right at the 60 level, that starts to give way, and we break down below here, that invalidates this pattern, and you start to see lower levels here. That's not going to be good for the markets.
All right, so those are the three charts basically that you are keeping a close eye on to see what comes next. Now, Ted, it seems like we're just stuck in this traffic jam. What would it take for the markets to get unstuck?
Well, I think the first thing is to recognize how we got here. Because really we've been in an unusual stock market regime, really going back to the great financial crisis. And I got a couple of charts to show what I mean by that. Here's a chart that shows the relationship between the Fed's asset holdings and the S&P 500. And I've circled a couple of things. One is that, the initial burst of Fed stimulus and quantitative easing that had happened just after 2008 and 9 did help the stock market. But then you see there's a tapering that happened, basically from 2018 onward. That was when the Fed tried to withhold some of, it tried to basically sell back into the market a lot of treasury bonds and mortgage-backed securities that had been holding. Now, that's a pretty volatile patch. You can see that there were a couple of big ups and downs during that segment. So that, for me, suggests that the Fed's balance sheet is one of the most important single things to the market right now. And now look at the other part of this chart. The other thing I've circled is that clearly when the Fed stepped in again with the COVID crisis, that it changed the slope of the line basically for the stock market. It really boosted stocks immensely. And again, that's because it encouraged a risk-on attitude. And so we've got to the point, now where really the stock market has, in a sense, even outgrown the Fed's current policy framework. So it goes back to what I've been saying the last couple of weeks, that is that the Fed really is the driver of all of this. And this is not a normal regime, normal in the sense that, for the rest of the stock market's history, it's been about what's happening in the economy, not what's just happening, with the Fed's balance sheet. So here's another way of looking at this. Is in the housing sector. This is the Case-Shiller National Home Price Index. The fit isn't as good, but clearly the Fed's intervention into the economy after the great financial crisis did boost house prices again. Again, the slope of the line for house prices is rising pretty rapidly, and it's keeping right up there with Fed asset purchases. So again, what that tells me is that right now we're in an asset economy that is driven by low cost money and by low interest rates. Now, the paradox is that on one hand, people are worried about inflation. Other people are worried about lack of growth. I mean, that doesn't make any sense. You've got to choose one or the other. And I think that reflects the fact that people are they don't know what the Fed's going to do next. The Fed says it wants to, start withdrawing support for the economy. But what they really mean is the stock market. But if they do that, then, we will see a pullback in stocks. So for me, the critical thing to do is to look at, what investors need to be thinking about as we go into this resolution of this issue. And there's four things I think people need to be doing. One is that we need to accept that the good times are over in terms of just being able to pick a stock and have its price go up, because all stocks are going up. Like Dave Portnoy said last year, stocks only go up. Where's Dave now? I heard he's losing $150,000 a day.
He's eating a lot of pizza.
Yeah, he's eating a lot of pizza. So those broad-based share price gains that we saw last year, and they're not going to happen for a while, right? Because and I'm going to come back to this. We need to have valuations come back into an appropriate alignment with earnings. So the second thing is that finding good stocks is going to be about fundamentals. It means people like Clint, Lee, and I have a lot of work to do. We have to go sniffing out, companies that are sort of in that broader index, that Wilshire 5,000, whatever, maybe not even in the S&P 500. Who are the rising stars? Because not everybody's going to be rising. So story stocks, IPOs, SPACs, all that stuff is not going to cut it. Personally, I'm favoring dividend growers, that have a yield in excess of around 5%, at strong, safe dividends, and then compounding them, because I think that's a good alternative to gambling in the stock market. Now, the third thing, and this is what I was saying earlier, it's going to take a while for earnings to catch up to valuations, and you're going to have to be patient for it. Here's a chart that shows basically EPS growth projections for the S&P 500 as a whole. The first quarter obviously was a smash. We had a really good earnings relative to what came before, of course. Second quarter is also looking like it's going to be a good one. But then things slow down. They have to slow down, right? Because relative to where we are coming from, you can't expect to have earnings grow like that, especially if we have doubts about whether we're going to have stimulus, whether we're going to have an infrastructure package, etc. So people are going to have to be patient as earnings catch up to high valuations. The fourth thing I would suggest is that people need to watch their holdings in high beta, high price to earnings stocks, because having valuations come back into line with earnings works both ways. It's not a given that a stock price will remain high until earnings catch up. The stock price can also fall. Now, I'm conscious that I haven't really answered your question, is where are things going to go next? I think things are going to carry on as they are for a while. And I think what we're waiting for is a resolution to this question of, is the Fed going to start withdrawing from the economy or isn't it? We know that Chairman Powell wants the federal government to take responsibility for the economy in the form of fiscal spending. He's been begging for it, which is pretty remarkable coming from a conservative guy like that. But that is the reality. We have to move from monetary to fiscal policy. That's the only thing that is going to determine whether the market breaks out of this holding pattern. Otherwise, we're just going to be looking for little flashes here and there. Now, Clint and I have talked about a couple of recommendations. One of them is if you want to hold through this, that there's an ETF called SPLV. It's basically the low volatility ETF that Clint mentioned earlier. And here I want to bring your attention. Here's the chart of it. I just want to show that historically it's pretty close to the S&P, right? This low volatility ETF is not all that different. But look at the divergence now. So two things could happen here. One is that it could catch up. And if it caught up to the S&P, you'd make good bank. The other thing is that the S&P could fall back down to it. But because it's low volatility, it wouldn't fall by as much. So that's a good defensive play that could turn into an offensive play if things work out. But my personal favorite is real estate. Here's VNQ. This is the Vanguard Real Estate Index ETF, and you can just see what has happened. I mean, since the beginning of this year, it has broken away from the market. I still think safe as houses is a saying for a reason. It's not really houses. There's all kinds of real estate, but we are seeing good gains there. We've had very good gains in our REIT stocks. When you look at it on a total return basis with compounding dividends, that's beating the market, and that's what you want. So prediction is more of the same until we get clarity, and it comes down to Washington, and it comes down to New York, and basically the Fed, and we're in the politicians' hands. That's my story. I'm sticking to it.
All right, well, there you have it, folks. 3 charts to watch, 2 ETFs to play. What more could you ask for? But again, if you are interested in more, please join us at the Bauman Letter. Until then, we'll see you next week.